Everybody's super confused in the real estate industry right now, so I just wanted to kind of outline a few things and sort of explain what's going on. So at the beginning of COVID, when it came to construction materials and and gas prices and all of these things, we basically had a decrease in inventory. The oil drillers started to produce less because everybody was staying at home, they weren't driving around. And then they have an incentive not to create a bunch of new wells right now to increase the supply, because we told them they have to switch over to renewable energy in the next 10 years. And 8% of our oil was coming from Russia, which we're not getting now. And so there's a massive decrease in supply, partially due to COVID, partially due to global economic factors, and because of our policies that we have, all at the same exact time, which drives prices way up. And so right now there's a conflation in the idea of the interest rates and the gas prices. This will have a slight effect on it, but most of the effect of the gas prices being high are these other things. And so the governing party, the Democratic Party right now, until the American people lessens the pressure on them, saying, hey, why are interest rates high? Why are we miserable? They're not going to stop, trying to make it look like they're doing something by raising and lowering interest rates and playing the monetary policy game. But it might not have anything to do with it. You might see those things change at the exact same time, and so it seems like they're connected, but there's sort of a bias behind it. Now, for the lumber prices, Canada started producing less lumber once COVID started. We started charging them 18 to 20%. That made our cost to build a house go up 34 grand right off the top. And so there are a lot of things going on in the back end that decreased our supply. A lot of people wanted to renovate their homes. Housing prices were going up, so there was a lot more new construction starts at the beginning of COVID. And so at the same time our supply is going down, our demand is rocketing up as we're coming out of COVID. So they're saying that inflation is transitory in these markets and it's due to interest rates and these different things. But it's just more so due to economic policy, monetary engineering, the global economic issues that are going on as far as different wars. And these really, in the supply chains with China and charging them all of the tariffs as well, and these things don't necessarily have as much to do with the interest rates as we would like to think. And so, the two biggest things aside from that is also going to be the fact that we're short 5.4 million homes already. And so what happens is when you decrease the interest rates and allow a bunch more buyers to borrow cheap money, and we're already short 5.4 million homes, there's only 10 homes to buy. So of course, now when you lower the interest rates and flood the market with another 70% buyers, you're going to cause those prices to rocket up. I don't really see that as a true housing bubble. And the reason is we haven't had the typical real estate cycle of the increase in prices and then the overbuilding and then coming down on this recession side. Now, we're going into a slight recession induced by the Fed increasing the interest rates, but the problem is we're going into this recession different than any other one. All of the other ones, we had an oversupply of real estate, and so as things started to turn around as they decreased interest rates, people were able to buy up those homes and prop up the economy. But right now, we're not going to be able to do that as well because we're going into the recession short on those 5.4 million homes. Right as they started to build a bunch of homes, about last year and have a bunch of new multifamily starts and single family home starts, essentially they got hit with this interest rate issue and the decrease of the amount of buyers and the softening of the amount of buyers, because a bunch of buyers were built up during COVID, and as COVID, kind of died off or whatever you want to call it, a lot of those buyers, all that pressure that was built up, it started to decrease over time and go back to the normal buying levels, right? Because if you didn't want to buy during COVID because you had no idea what was going to go on with the economy, you're going to wait until things seem to be normalizing a little bit and you're going to purchase then. So we have a decrease of the supply of materials, the ability to renovate, decrease in lumber, increase in prices, increase in contracting prices, no inventory, and we have a bunch of buyers. Of course that makes the housing prices go up, But now that things are starting to normalize and, hopefully we make a partnership with Canada, get some cheap lumber, hopefully we figure out something policy-wise to incentivize the crude oil drillers to drill some new wells. We have to incentivize them somehow. That's going to cause things to normalize a little bit. Now, the Federal Reserve is going to view this as, oh, okay, the interest rates are working, and they're going to start to decrease the interest rates, and that will push some new buyers into the market. Now, the reason that I don't have too pessimistic of a view on the market, and I think maybe we have a little bit more room to go down as we go into the winter this year, but I don't see it being a massive downflux, is we're not, like I said, we're not going into this housing recession with an overbuilding of homes, and then people are going to lose jobs as we go into the recession, layoffs, and people are going to sell all their homes. There's not really any homes to buy right now in America. There's no homes that are built. So the problem is actually the opposite. Going into the recession, we need to figure something out to convince the new developers and to incentivize the renovation projects and incentivize the new multifamily starts this year. In the Bay Area, we only have 15 to 20,000 new units coming on the market across the entire Bay Area a year, and it's just simply not enough, even if you account for a massive drop of a couple hundred properties extra a month. If you look on Zillow right now, even after the prices dropping 20-30% to pre kind of COVID levels essentially, you still see 50, 60 people saving these properties on Zillow and still probably getting 2 or 3 offers. So I mean, let's assume you drop the price another 10%, you're still probably going to have 1 or 2 offers on those properties. And I think that's going to be very similar across a lot of the markets in the US, just because there's a lack of that inventory. So how do you take all of this information and kind of formulate an investment strategy around it? Now, I think what's going to happen, and my opinions might evolve over time, but I think what's going to happen is going into the recession, something's going to kind of trigger the multifamily developers to continue building, whether it's policy-wise or other words, or the decrease in lumber costs and stuff like that, increase in profits. But these big developers are going to be the only ones that are going to really be able to make money on a large scale by building 20, 30, 100 units at a time, and because the profits are going to be lower as interest rates are up, right? And I think what's going to happen is we're going to have a lot of multifamily being built during the recession, and the government's going to incentivize that, and that's going to help bring us out of the recession and stimulate people purchasing. But there's not going to be a lot of new single-family home starts because there's not going to be any profit in it. And so what I would do, specifically in the Bay Area, is if I'm going to live in that home for 10 years, I'm going to buy a single family 3-bedroom that's going to be very desirable when all of these new projects are finished in the Bay Area in the next 10 years, and somebody wants, they don't want to live in a multifamily, they want a home. So that house is going to appreciate in the value a lot over the next 10 years, I think. But it's not going to cash flow very well right now because the interest rates are so high. Now, where you may be able to cash flow is the 1 or 2 bedroom apartments. So if you're a little bit younger, maybe you can't afford the house, or if you're looking for that secondary investment, what I would be doing is looking at the 2 to 3 bedroom condos that are going to have a 4 to 6% yield rate in the Bay Area. And it's pretty hard to cash flow in the Bay Area, but it might be a little negative right now, and that's why it benefits you if that's still your primary residence and you're a little bit younger. But as we come out of the recession, they lower the interest rates, you're going to be able to refinance that property in 3 years, and then that's when it's truly going to be cash flowing for you, and that's going to be kind of a perfect little investment, kind of nest egg. And that's sort of the strategy that I'm looking at for kind of my beginner investors out there. Now, if you're beyond that, it's all going to depend on the asset classes that you go after, the typical your kind of risk to reward ratio that you're looking at. If you're a more risk adverse investor versus being risk prone, things like that. So if you need help with anything, if you want me to help you analyze deals, just make sure to reach out to me at 408-275-5601, and I'd love to talk to you. See you guys next time.